Now let's go ahead and take on this example from the chapter on dividends. It is a question from your study material, right?
Yes, sir.
Here we go. Yes.
Following information is given pertaining to DG Limited. Number of shares outstanding 1 lakh shares. Earnings per share 25 rupees per share. P ratio 20. Book value per share 400 per share. If company decides to repurchase 25,000 shares at the prevailing market price, what is the resulting book value per share after repurchasing?
Now that is a question. Calculate the book value per share after share buyback. But please remember, book value per share is nothing but there are two ways of finding out the book value per share. Either you can add the amount of equity share capital plus reserves and surplus and divide that by number of equity shares, or the best way to understand is you take all the assets on your balance sheet, the total assets, minus all the outside liabilities, and you get the net assets available to the shareholders and divide that by number of equity shares. You get value per, the book value per share. Is that fine? Have that in mind. And you should also know this formula by now. Price earnings ratio equals market price per share divided by earnings per share. Or I can say price earnings ratio multiplied by earnings per share will give you the market price per share, right?
Yes.
The price earnings ratio into EPS is market price. Now here the question is, it is given that your company is going to buy back 25,000 out of 1 lakh shares outstanding. There are 1 lakh equity shares on your balance sheet, issued shares. Of that, your company wants to buy back 25,000 shares at the current market price, which is not given. Refer to the solution out there. Now first you got to calculate the current market price per share. What is the formula? You can take the price earnings ratio. How many times? It is given as
In 20.
20. What is the price earnings ratio?
It is given as 20.
20 times. And what is the earnings per share?
It's 25 rupees.
25 rupees a share. So our price earnings ratio 20, that into rupees 25 per share will give you rupees 500. Write that very, very clearly in the examinations. 20 times rupees 25. Do not just write 20 into 25. It is 20 times price earnings ratio, that into rupees 25 EPS, which is equal to rupees 500 per share. And your company is going to buy back 25,000 shares at rupees 500 per share. Works out to rupees 1 crore and 25 lakh. So 1 crore and 25 lakh is the amount that will be spent on buyback. That is cash going out. Is that fine?
Yes, sir.
Now tell me, what is current book value? There are 1 lakh shares outstanding into rupees 400 per share, which works out to rupees 4 crore. That is 400 lakh. But please remember, this 4 crore is nothing but your assets minus liabilities is supposed to be the net assets available to the shareholders. That divided by 1 lakh shares is given 400. Is that fine?
Yes, sir.
I am emphasizing on this point because when 1 crore 25 lakh is spent for buyback, the assets will go down. Yes or no? The cash on your balance sheet will reduce by 1 crore and 25. The 4 crore will include a cash as well. Now from that you subtract 1 crore and 25 lakh. Now what is the net assets after buyback? After you spend 1 crore 25 lakh, it's around 2 crore and 75 lakh or 2.75 crore. Now we know the number of shares will be now 1 lakh shares minus 25,000 bought and cancelled leaving a balance of 75,000 shares in the hands of the shareholders, right?
Yes, sir.
Therefore, in case you want to find the book value per share post buyback, very simple. Divide rupees 2 crore and 75 lakh. That is 2.75 crore. Divide that number by 75,000 shares. You will get the book value per share, or I can say the net asset value per share after buyback, post share buyback. It's going to be rupees 2 crore 75 lakh upon 75,000 shares. It is rupees 366 point something, or say approx 367 per share. Is that fine?
Yes, sir.
And now I'll take on one more example I will discuss in the same video. Now please refer to question number. There is a previous sum in your study material. Even this is from your study mat. Okay.
Yes, sir.
Now please read the question.
Mr. H is currently holding 1 lakh shares of HM Limited, and currently the shares of HM Limited is trading on a Bombay Stock Exchange at rupees 50 per share.
Very clearly given that you guys are holding 1 lakh shares in a company, and the company shares are trading at rupees 50 in the market. Next.
Mr. A have a policy to reinvest the amount of any dividend received into the shares back again of HM Limited. If HM Limited has declared a dividend of rupees 10
Please
per
remember, whenever the company is declaring a dividend, the shares will be whenever the dividends are proposed, whenever the dividends are declared, that is at the AGM, the shares will be trading on a cum dividend basis. Please remember that. You all study this in your Companies Act, something called the cum dividend and ex dividend. You know, there's something called the record date. You study in Companies Act. Now, please remember this 50, once the dividends are declared at the AGM, the shares will be trading on a cum dividend basis. That means rupees 50 is the cum dividend. Because once the dividends are declared, people who are going to buy the shares in the company know that by paying rupees 50 for the share, they'll get rupees 10 in the form of dividends, right? Therefore, I can say the ex-dividend price, that is EX, excluding dividends, will be how much? 40 rupees, which is called the clean price. What is that? That 50 is called what? Dirty price. That is the cum dividend price. And what is the ex-dividend price? Should be 40. Because once the dividends are paid by the company, the share price will fall to how much? 40. Please remember that. Okay. Now, what is the question asked?
Please determine the number of shares that Mr. A could hold after he reinvest dividend in shares of HM Limited.
They say, please calculate. Just see the examiner's plate now. They are telling, please calculate the number of shares that you will be holding after dividends have been reinvested in the company shares, right? Now tell me how much dividends you want to pocket or bucket. You're holding 1 lakh shares.
Yes, sir.
Into rupees 10 per share. How much? You will get 10 lakh rupees in cash, right? From the company.
Yes.
Suppose you want to use 10 lakh rupees to buy shares in the market. What is the market price per share? It is not 50 now.
Yeah, it is 40.
Because once the dividends have been paid by the company, the share price will become ex-dividends. It will become what? 40 rupees a share. Now divide 10 lakh rupees cash you pocketed, divided by 40. You can buy 25,000 shares in the company. Yes or no?
Yes, sir.
Divide 10 lakh rupees dividend received by rupees of 40 is a current market price. So you can buy 25,000 shares in the company. Now tell me how many shares you'll be holding after this, after reinvesting the dividends.
1,20,000.
1 lakh shares plus another
25,000.
what you bought now. In all, you'll be holding 1,25,000 shares. Is that clear?
Yes, sir.
Okay, guys, these sums were not there in the older, that is, 2023 study mat, right? And as one reason I'm discussing this, because people who did not clear in 2023 and are writing the 2024 exam, right? So 2025 in this case got Jan 25, right? So you can go through these two examples.
Yes.
So guys, good luck for your examination. Bye bye.